Well, no surprises from the RBA today, keeping rates on hold at a historic low of 0.75%. While house prices are showing no signs of slowing down, the Reserve Bank is tipped to deliver at least one more cut in February. I spoke to AMP Capital's senior economist Diana Mousina and senior economist with ANZ Felicity Emmett. Diana, Felicity, welcome. We've had house prices jump, particularly in the last month, their biggest monthly gain in 16 years, first annual rise for 19 months. Is this what the RBA was expecting when it made its 3 cuts this year?
Well, if you listen to what the RBA has been saying in their commentary, I think that they're really playing down the role that they've played in stimulating the housing market. I think that the majority of the reason that we are getting the boom in house prices is down to the fact that the cost of borrowing has been reduced because the RBA has cut interest rates 3 times. I mean, there are other factors at work as well. We had the federal government win the election, the Liberal government won the federal election, and we had APRA reduce interest rates that the banks need to use when assessing mortgages. But the main driver has been the RBA. So the more interest rate cuts that we get, I think that the more the housing market will be stimulated.
Felicity, were you expecting to see such stimulation in the market?
Look, it has been a bit stronger than we expected. I think there's a bit of an element of pent-up demand and still low supply, so they have taken off much more strongly than we expected. But I think to some extent the RBA really expects rate cuts to flow through to asset prices. It's something they talked about in their statement today, and that eventually that will feed through into higher consumer spending and stronger housing construction.
The bank held rates on hold today. Any surprise in that result?
No, look, that was our view, that they would keep them on hold, and we think that they are waiting a bit longer to have a fuller assessment of the data. In particular, I think they really want to see the national accounts tomorrow for the 3rd quarter and get a bit more information on consumer spending and some of the other indicators there.
Diana, with these rising house prices, perhaps an unintended consequence for the RBA, what else can they be doing?
Well, we think that we are due some more stimulus into the economy, so we do think that there is a need for the RBA to bring down interest rates further for the main goal to meet their price stability mandate. Inflation is too low in Australia at around 1.5%. Then their mandate is for 2.5% inflation. So they're missing that mark. The unemployment rate is too high for the RBA's liking. So there's definitely more that they can do. We think that rate cuts are one of the things that they could do. We also think that it's likely we'll see some sort of quantitative easing program from the Reserve Bank next year. But the main way to really stimulate the economy at the moment is through fiscal spending, and that's primarily through tax cuts or some form of fiscal spending that's financed by the Reserve Bank. And when we talk about that, we're getting into that helicopter money territory.
Felicity, just sticking with property prices for a moment, if property prices are putting the RBA under pressure while they're cutting rates, what happens if and when they eventually start to lift them?
Oh, look, I think that is a long way away. I think, Phil Lowe has been very clear that we're going to have a very extended period of low rates. I think it's really hard to see in the next 5 years any sort of material increase in interest rates. So I think that we're probably in for a fairly extended period of low rates and rising asset prices, and hopefully that will eventually feed through into the broader economy.
Diana, Dr. Lowe suggested the floor will be 0.25%. Do you think we'll get to that?
We do. We had been expecting a floor of that 0.25% for months now. So we weren't too surprised by that. The reason that we expected it was because, well, really, if you look at the international experience, the Bank of England, the Federal Reserve in the US, that did seem to be that floor for global central banks. But beyond that, I do think that there's a chance that we will get some sort of quantitative easing next year, which I think the market needs to be prepared for.
We've talked about property, residential property. What's the option for businesses in this low interest rate environment?
I think that that's a really difficult question. When we look at business surveys, the key thing that businesses say that they want to see is high consumer demand, which is stimulated through other forms of economic growth. So I don't think that interest rates are an impediment to business investment at the moment. What they really want to see is just stronger economic growth. And with the economy only running at 1.5%, when it could probably be running at 2.75% or 3%, we're below our potential and it needs to be stronger. But the good news is that at least the mining story of the business investment side is starting to finally look a little bit stronger.
What do you think the story is for businesses, Felicity?
Yeah, mining is certainly looking very encouraging, especially when you think we've had a very long period of sharply falling mining investment. But it's really the non-miners that are not very optimistic. You know, last week we had news that they downgraded their investment plans for the coming year, and I think that really is quite a worry. And I think it's, you know, they've got very low profit growth, consumer demand is quite weak, and I think there's still a lot of global uncertainty, and they're worried about what the next year or the next few years is going to bring.
As I said, Dr. Lowe has suggested that floor of 0.25%, and then there are indications that quantitative easing would be the next step, buying government bonds. Is that the right course of action?
Look, I think that is certainly a risk that the RBA will pull down that path. Next year, we do think we'll get more rate cuts that will bring the cash rate down to 0.25. At the moment, we don't really think that they will need to step into quantitative easing next year, but there's certainly risks, especially if we get any sort of shock, or as Lowe outlined last week, we have this consistent moving away from their inflation and full employment targets. But I don't think that that's something for 2020. I think that's probably a little further out.
Diana, tomorrow we get those all-important growth numbers. What are you expecting?
We think that the third quarter was still pretty soft. We've got quarterly growth about 0.5%. So if you read into the RBA's forecast, I think it'll be a little bit below the RBA's expectations. They expect about 0.6 or 0.7%. So it only mean that annual growth is about 1.6%. It's very low. And the private sector of the economy is in a recession, or private sector recession, if you like to call it that. So that's why it can feel like for some areas of the economy like they are in a recession, because the private sector isn't growing at all. The only areas that are growing is public spending and our external sector or exports.
Diana Mousina and Felicity Emmett, it's been great to talk to you both. Thanks for coming in.
Thank you.